Hi, we're Team Great Solutions. I'm Jessica Martinson and I am the Chief Executive Officer.
Shane Meyer, I'm the Human Resources Officer.
I'm Alyssa Iwan, I'm the Chief Marketing Officer.
I'm Chris Morello, I'm the Chief Financial Officer.
And I'm Ha Kong, and I'm the Chief Operating Officer.
So we as Great Solutions, we have decided to be the most trusted athletic footwear brand worldwide. Our mission statement is that we, Great Solutions, are committed to producing innovative, high-quality footwear, not only to the fitness world, but any customer searching for comfortable shoes. We will strive to grow financially while remaining eco-friendly and providing great employment opportunities for our entire footwear team. Achieving to be a trusting, ethical, and fair company is our goal while becoming the most globally recognized shoe provider. So our strategic approach, we actually have a lot of ways that we wanted to be strategic, but we really wanted to be a 5-star shoe with many models available. We didn't want to be too low on the star level, but we didn't want to be too high, so we just thought middle ground would be great for us. We also wanted to have a variety of options for our customers so that we could appeal to anybody in the market, whether they be a kid, a teenager, or an adult. We also wanted to have a competitive price because we are against so many other companies that we really wanted to strive to have kind of that middle ground price where people could actually afford it. And then we also wanted to have really great celebrity appeal. We wanted a celebrity that could sell our shoes, wear our shoes, and someone that any customer could relate to in order to really, appeal to our shoe and to buy our shoe. We also wanted to have a strong marketing program in both celebrity presence and in our marketing programs. And we wanted to have really great rebate offers and delivery times, as you will see further in our presentation. We also wanted to focus on branded and internet regions, so we really wanted to make sure that our internet sales were just as good as our in-store sales, and that's something that we really strived to be really great at. We also wanted to distribute our product evenly and clear our inventory when possible because we didn't really want to have many shoes left over at the end of the year. We kind of wanted to start fresh with new models and not have to put all of our old shoes on clearance and sale. And then we also wanted to purchase capacity when possible from other companies in order to sell more shoes and to have more sales under that kind of market. We wanted to upgrade our plants when possible. Just to make sure that we were doing a really great job in every region. And then we also, for our employees, we wanted to have really great incentive pay and base pay increases yearly. And then we also wanted to have diversity programs and ethics training for them as well. So as you will see further in our presentation, we really implemented a lot of our strategies that we had decided in the beginning. We'll just go through the list year by year and just let you know how we did every year.
We have a specific strategy that we wanted to use. During the practice rounds, we had some success, but we still weren't sure exactly what we wanted to do. So our goal was to keep it simple in the beginning. We wanted just to expand our market shares in North America, Latin America, and Asia. And then maybe eventually in the second or third year, purchase some capacity which would increase our production and ultimately increase our sales. Specifically, our year 11 goals were to invest in online sales and our overall internet segment. We wanted to have a lot of success there. We also wanted to implement total quality management training for our employees. This would help save on some material costs and reject rates. We also wanted to have a 6-star rated shoe in year 11. And also wanted to implement some workforce diversity programming for all our employees. Our year 11 results weren't exactly what we were looking for. The outcome wasn't expected. We ended up in 11th place out of 12 teams. Our EPS, ROE, stock, and image rating and credit rating were all well below the investors' expectations. Our branded market share was at 9.4, which wasn't too bad. It went up a little bit, but our internet market went down 2% to 6.8. Our production costs were way too high for achieving the 6-star rated shoe. We also weren't using 100% capacity utilization, which resulted in a lack of production, which meant we couldn't sell as much as we wanted to. We also had a lack of marketing. We didn't spend a lot in any region, which affected our demand rates. The price was way too high for our internet segment especially, which we didn't have an effective plan there, and we didn't have enough models to compete with other companies. Going into year 12, we knew we had to fix a lot of things. Our first main concern was a 5-star rated shoe instead of the 6-star rated shoe. We also wanted to increase the number of models and make sure we get celebrities this year around. We also changed our production capacity to 120%, which allowed us to produce more shoes. We also wanted to increase our marketing substantially across all markets. We also wanted to lower our internet price to be more competitive against other teams. And we wanted to lower our production costs to produce the 5-star rated shoe, which would mean more profit for us. The year 12 results were a lot better than our year 11 results. We met our credit rating. We exceeded our ROE. We actually doubled our internet market share. We increased overall operating profit margin by 5%. We also were also able to obtain a celebrity endorser, which helped our demand across all the markets. We ended up actually jumping from 11th to 3rd place, which earned us the Leapfrog Award, which is for the most improved score in 1 year, and we got a bonus point in our total score. We still had some problems in year 12. We had a large amount of inventory surplus. We had a poor image rating, and we fell short of investors' expectations for EPS, stock price, and image rating. Going into year 13, we wanted to build off our success from year 12. We wanted to purchase capacity right away, but not make any large moves that would change what we did in year 12 because we had so much success in year 12. Our goal was to drop our internet price to be more competitive, increase more model availability, and offer better incentives like rebate offers and faster delivery times in certain markets. Our year 13 results were pretty good. We jumped from 3rd to 2nd place overall. We improved our internet segment demand by 3%. We increased our branded market share. We improved our operating profit margin for the 2nd year in a row. And we obtained another award, the Bullseye Award, for accurately forecasting total revenue, earnings per share, and image rating, which we also got another bonus point for that in our game-to-date score. We still had some issues in year 13. We fell short of our investor expectations with EPS, ROE, and stock and image rating, but our numbers were improving all from year 11, and the scores were really close to what the expectations were.
In years 14 to 16, our strategic plan, some of our key business strategies were to invest more in our company so we can increase our internet market share in all regions. Another one was to purchase a capacity and or more capacity in different regions. Also, we wanted to keep increasing our positive operating margins. Year 14, some goals that we had were to maintain and increase our TQM, Six Sigma, and best practices program. We also wanted to find new celebrity endorsers to go along with the one that we already had. Also, increase our internet market share. Some expectations for year 14 were to maintain the best credit rating in the industry, as well as increase our base wage pay from 1% to 3%. Year 14 results, some strengths that we had, that we purchased our first capacity, which was in North America. We increased our operating profit margin by 3%, and our stock price rose $27.17, which exceeded investor expectations significantly. Some problems and difficulties that we had were that we lost some consumer demand because of our high prices compared to our competitors, other than in Latin America. Also, our image rating is lower than investor expectations, which is at 67, which we do plan on improving. Year 15, the goals that we had were we wanted to expand our marketing advertising program. We needed to put more money into the program itself so that we can have higher demand. We wanted to reduce our surplus and or shortages of inventory in different markets. Also, we wanted to increase incentive pay for our workers. Some expectations that we had were we wanted more plant capacity expansions, so build off of year 14, and potential plant upgrades, as in to cut costs and such. Year 15 results that we had, we exceeded investor expectations in return on equity, image rating, and as well as our stock price. We increased our rebate offers in all regions, as well as we purchased initial plant capacity in Latin America. Now we had strong market shares with branded and internet segments, which followed up all of our strengths for that year. Some of the pitfalls that we had were we had too much excess inventory in certain areas, such as Latin America. Also, we had a lack of celebrity endorsers because of the high competitive market that we were in. Year 16, the goals that we put together were that we want to continue to build a strong marketing program, keep building off of the appeal, the celebrity appeals, and we wanted to keep putting more money into the advertising aspect of the program. We wanted better celebrity bidding. Due to last year, one of our goals was to get a better celebrity and get more bids on them. Due to a high competitive market, our bidding was a little off, but this year we plan on exceeding that. And also, we wanted to continue to build off last year's success, and as well other years. We had been strong through the game so far, we'd like to continue that. Now 16 results that we had, some strengths that we had were that we exceeded investors' expectations in our credit rating and as well as our ROE. We increased our online sales, and we were still highly ranked in the game overall, and we had the lowest cost of pairs sold in the industry. Now some of our problems, which we did have many in year 16, was that we got caught up in our strategy. We were almost coasting in the game due to our highly ranked position in the game, which hurt us. As well as we had large inventory shortage in North America, and in Asia we had too much inventory. So we needed to build off of that coming into the next year, building on finding the right inventory for the right market. And lastly, our operating profit margin dropped 5%, which is the first time that happened in the game.
So our goals and expectations in year 17 were to lower our wholesale segment prices, maintain profit margins, increase our advertising, and upgrade our plants if possible. We also wanted to purchase capacity, increase our rebate offers, and increase shipping time because it ended up that 1 week shipping became too costly for our company. However, what actually happened were some strengths and some weaknesses. Our strengths included all branded market shares increasing. We purchased more capacity in North America and actually paid off our 10-year loan. We also increased our rebate offers by $1 in all of our markets and saved on shipping costs by increasing delivery time, as spoken before. However, some negatives of year 17 were that our operating profit margin decreased for the second year in a row. We had a major inventory shortfall in Latin America and a minor one in Asia, and we actually had a large amount of excess inventory in Europe. And we lost internet market shares. Year 18, our expectations were to try new strategies to shake things up a little bit. We noticed that other companies seemed to be doing exceedingly better while we kind of stayed in the same area. So we increased retailer support, and we wanted to purchase large amounts of capacity if possible. We also wanted to focus more on celebrities. In past years, we noticed we kept being outbidded by other teams and actually being outbidded by the same teams. And as we searched through their history, we realized that they were about the same amount. So at this rate, we noticed how much we needed to bid in order to win a celebrity. And we also wanted to create a safety net of inventory to capture consumer demand. Some strengths of year 18 were that we moved back to third place. We exceeded investors' expectations in 4 of 5 areas. We had large capacity purchases, and we improved retailer support. So that increased our market shares, and we upgraded to Plant Option C. However, we had some pitfalls. We were lacking celebrities, our strategy ended up not working out, and our internet sales were starting to decrease. In year 19, we did have a successful year in year 18, so we wanted to build on that year by increasing our advertising, but not making any major changes because we did end up having a successful year. The results, we actually moved to second place, and so we continued our positive momentum from year 18. Our stock, EPS, and credit score were well above investor expectations, and we purchased more capacity, so our goal was to block companies from expanding. Inventory was still an issue for us though in year 19. We still fell short in inventory, and the first time in the whole game we did not have any endorsers. In year 20, our expectation, our overall goal was to end the game on a positive note. We wanted to spend a lot on celebrities since we did have the ending cash to spend that money, and we wanted to maximize our advertising spending. What ended up happening was that we bought up all the North American capacity remaining. We had 2 celebrities, the first time in the game where we had more than one. So our strategy, which ended up poorly in year 18, worked out for us in year 20. And we ended the game having top segment in terms of internet and branded shares. We were beyond investor expectations in that realm. However, our ROE dropped substantially, and we dropped to a spot to finish in 3rd place overall. So at the end of the game, we decided to go with a management buyout decision. We felt as though this was the best decision for our type of company. Overall in the game, we were a fairly successful company, and so we still want to have claim in this and capitalize on the success that we've had thus far. And with the management buyout decision, we can end up being shareholders. We did not choose an IPO decision because we did not want to become a public company. We felt that being a private company has worked out for us thus far, and we wanted to stay that way. In an acquisition decision, we felt as though that decision was geared more towards companies who were struggling financially, and that was not the case for us. Some advantages of the management buyout decision was sustainability of the company. We felt as though our company had been doing well, and we wanted to sustain that success. We also believe in the current management that we have, and that management in the decision gains ownership of the company. And so that results in smooth transitions for all of the employees in the company, and that way those employees feel very involved in the decision that we have made. It reduces uncertainty and anxiety for those employees because it's people that they already know, people that have already been on the management team, and that way we can kind of go into a smooth transition and have further success in that company. And we felt as though it was sensible options for banks, venture capitalists, and investors in the company. The only thing we're kind of worried about in the management decision, though, is that the management team may not have the funds to buy out the company for what we're selling it for. That way they may have difficulty with loans to try to get to buy the company out. And struggles with the management team that we already have had may still remain when they become owners of the company. And founders, so we will not manage the company on a day-to-day basis. That might change the atmosphere of the company and might result negatively. So in year 11, our net worth ended up being $163,629. That comes from subtracting our total liabilities from our total assets. However, in year 19, our net worth ended up being $526,229. In that case, our growth in just 9 short years was a difference of $362,600. Because of that growth, we decided to sell our company for $900,000 to our management team. We want that to happen in year 22, and we will not have any change in facility as far as implementation of this plan goes. That way, if management team wants to change facilities, that's going to be their decision to make as current owners of the company.
Okay. Overall, for Great Solutions, we had many strengths, weaknesses, opportunities, and threats, as did any company. For some of our strengths, we had a strong advertising budget. We had a lot of shoe models, which were great for our customers to choose from. Having a good variety is very important. We were consistently profitable, unlike some of our competing companies, which they had profits that were low in one year, high in another, whereas we were very consistent with that. We had plant upgrades and expansions. and above average rebates. We had low costs and invested in our employees, which is really important. And we were upper tier in terms of overall branded and internet market share. Some of our weaknesses included our poor distribution plan. We had a lack of celebrity appeal, which is not very good for customers because you want them to be able to relate to your celebrities. We did not have any perks with our delivery time. That was a problem with us for most of our years. And we did not take any major risks. We didn't look much into our stock options, and we did not have any private label bids. And there was a lack of social responsibility. Overall, some of the opportunities that we could have had were plant capacity expansions. We could have grown in our market share with internet and branded segments, and we could have had some additional plant upgrade options. Some of the threats that we had at Great Solutions were a competition for our celebrities with our competing companies. We all wanted the same celebrities. Some of our competitors had better shoe prices as well as better shoe ratings. And our delivery time was always average. We could have sped that up a little bit more. And the lower cost companies were a big competition for us as well. As a team at Great Solutions, we learned many lessons. One of the things that we learned was to keep an eye on other teams and other markets. We wanted to make sure that we were watching some of the decisions that they made and then collaborate with each other to see what we should do as well. We wanted to maintain positive operating numbers, and we also learned that it's important to buy capacity every year rather than build because it's cheaper and helps our company in the long run. It is important that we have incentives, rebates, and fast shipping. We learned that customers really appreciate that and will be more inclined to come to your company if you have more incentives and et cetera for them. And then we wanted to maintain satisfactory distribution levels as well. We also learned that it's important to pay attention to celebrity appeal. If you have a celebrity that your customers can really relate to and are very popular, and as well as our celebrities that are comfortable wearing your shoe, it's really great for your advertising and for your customers as well. We wanted to make sure that plant upgrades and to keep production costs low is an important thing. And we also learned to clear our inventory. We wanted to pay attention to trends and exchange rates as well, and maintain advertising to increase market share. Individually, we learned lessons as well. What was something that we all learned was to collaborate with each other. Communication is success, and if you communicate frequently and as often as possible, it really helps run your company a lot more smoothly. We wanted to focus on each person's strengths at Great Solution because we realized that each person is different and has a lot of different strengths. And focusing on each individual's strengths is really going to make your company a lot stronger. We learned that organization is also key, and so to keep organized throughout the semester, we kept a binder that had all of our reports in it, all of our charts, and yearly documentations that we needed. So it was easy access, and if we needed anything, it was right in front of us. We also learned that it's important to be flexible and easily adaptable to change and difficult situations, because as with any company, situations can occur that you're not prepared for, so to be able to adapt to those situations and figure out what to do is really important. And we also learned that it's important to keep the responsibility delegated and hold each other accountable for any situation that comes up.
We are Great Solutions.
Thanks for watching.